Well, welcome, financial professionals. My name is Brendan Derone, Chief Distribution Officer here at E4 Insurance Services. And if you didn't know it, you're attending the B.R.E.W, Building Relationships Every Week. And today is Wednesday, April 28th. I'd like to go over our national days, or at least a couple of them. So today is National Blueberry Pie Day. I wasn't positive what I was going to have for dessert, but it's going to be blueberry pie, so I just need to go out and find a place that has that on the menu today. It is also National Superhero Day, so celebrate both fictitious and real superheroes in your life. And it is also National Great Poetry Reading Day. I know that we had Bill on the docket to talk about IRA Max, but I think instead I might just read some great poetry and fill up our time. No, not going to do that. Wouldn't be good, and we'd be missing out on Bill. So with that, Bill Anderson is a wealth strategist here at E4, one of our most experienced, and has had a ton of success. And we'd like to see or have him share that with all of you. So with that, Bill, I'm gonna hand it over to you.
Thank you, Brendan. Most experienced means one of the oldest, I guess. So we're just talking about that. Today, we're going to be talking about clients with IRA dollars. So do you have clients that are not maxing, well, I'm sorry, of their IRAs, they know they're not going to spend all of those IRAs in their lifetime, or they want to leave some of that to their grandkids, their kids, etc. Or possibly they're doing Roth conversions with their IRA dollars to clear them of the tax consequences. Or they might be one of those folks that think that they're actually in a lower tax bracket today, and when they fully retire and have to take the RMDs, that their tax bracket's going to be higher. So I'm going to draw a picture here of the tax wall. Now, this is a picture I draw all the time for people. Made it a PowerPoint presentation so that you can understand what I'm drawing. So when we look at the tax wall, there's really two sides of it. You've got the pre-tax side and the after-tax side. In our terminology in the industry, we think about it as qualified monies or non-qualified monies. How many of your clients look like this? Meaning that they've got a whole bunch of money on the left side of this tax wall and not a ton of money in the after-tax or non-qualified side. When you talk to 50 to 65-year-old people, many of them look like this. And they've got this tax bomb on the left side, right? So wouldn't it be ideal if we could actually balance it out where we would have half of our monies at retirement on the left side, pre-tax qualified, where we're gonna have to pay tax, and the other half of our money to have been cleared of the IRS partnership of going over the tax wall. Now, as advisors, what we see out there is when people do a Roth conversion, it's really for monies that they're going to spend. But how many people are clients of yours, or maybe even yourselves, where you're doing a Roth conversion, but you know you may not spend all of that money? Have you considered the use of life insurance to actually get some leverage? So we're going to actually talk about a strategy today, which we call IRA Max. So this is our dashboard of our website at E4. And I've clicked onto this. I'll show you the dashboard, sorry. Looks like that. If you go to the E4 sales concepts, we've got a bunch of them here. This is our policy review, life insurance policy review. This is our annuity inspection report. Down below here, we've got the IRA Max. So that's one we're going to talk about today. Get this annoying Adobe thing gone, and I'll blow this up so we can see it. So here's the situation for our example. Get onto the third page. It is a 71-year-old couple with $1 million inside of their IRA. We're assuming a 6% rate of return, 35% tax bracket. And then when they reach 72 RMD age, we're going to actually pull out, excuse me, and put it into a side fund, also earning 6%, kind of the right side of that tax wall picture, right? And we're going to assume the same 35% tax bracket for the heirs. Know that we can clean this up and change tax brackets, whatever, to personally fit your client's situation. So this is the do nothing approach. This is your 71-year-old couple, 6% rate of return. So $60,000, right? The end of the first year, it's worth $1,060. Then they need to start taking RMDs, the second column. They have to pay income tax on those RMDs. That's 35% of the $41,000. Getting us an accumulated account, and then that accumulated account grows. That is your side fund growing into the future, column 5. We've got the balance of your IRA, which we all know goes up, and then because of RMDs, goes down over time. Here's your total assets. Here's the ugly part of this, IRD, income in respect of decedent. In English, simplified, what that is the kids paying mom and dad's top tax bracket after they've passed away, income tax on these dollars. And I'm not assuming there's any sort of stretch it out for 10 years or anything else going on. It's just taking the money by the kids. This is the net after tax numbers, okay? On the 5th page of this report, I'll blow this up a little bit so we can see it better. This is dumping out of the IRA over a 10-year period of time. So taking it from the left side of the tax wall over to the right side, paying 35% tax. It's $128,000 per year, column 3. Paying the income tax, column 5. $83,310 is what's left, excuse me, of the life insurance, or of the money, and we're going to put that into a life insurance premium over here on column 13. The real benefit of this strategy is the IRD actually ultimately disappears. Now, obviously, in this analysis report, we're leaving a balance in the IRA of $113. We would just cash out of that after that point, right? But look over here. Here's the net, because life insurance is income tax free, and if properly structured, estate tax free as well. This all goes on to the family without any taxation. So if we go up to page 3, in summary, this age 85 is their joint life expectancy. The blue box is do nothing. It's their $1 million a day at their age 85, 14 years from now is worth $1,376,000. Whereas the repositioning with the life insurance is $2.8 million. And then we're looking at it also in this report 5 years prior to joint life expectancy or 5 years after joint life expectancy. This is an incredible report. So with that, I'll just go back to our from the current slide. There we go. In summary, think back to these clients again. Who in your book of business is between 60 to the late 70s where they don't really need all of their qualified monies? My suggestion is call your E4 contact person and maybe we can run one of these reports for you. Or the desire to pass wealth on to future generations, or they understand the tax arbitrage and they're willing to pay lower taxes today so that their beneficiaries' family can get at those funds without any income taxes down the road. And then the other one is who's doing Roth conversions. Some of my largest cases that I've been involved with in the last couple of years are clients that are already doing Roth conversions. They already understand the concept of getting the monies over the tax wall, but we, myself with their advisor, has had an opportunity to share the leverage of the life insurance for the funds that they may not need. So with that, that's a quick look-see, if you will, of what this is all about. Here's my contact information, but if you don't know me, contact E4, contact your E4 connection contact person. We're more than happy to help you out and run these sorts of reports. Now, I'm going to tease on our presenter next week, or kind of lead into. Linus Seducius is an advanced markets attorney for one of the carriers that we work with. And there's a new publication out by the IRS, 590-B. What this is dealing with is the non-spouse inherited qualified accounts and the stretch rules. What everybody thought, all the CPAs, practitioners, attorneys, et cetera, thought was their interpretation of the rules is not exactly what is actually being said by the IRS. So join us next week. And with that, I'm going to hand it over to those that run this call every week. Brendan?
Well, I don't run the call every week, but I'm running the call today.
Yes.
Thank you, Bill. Nice job. I do have at least some personal follow-up questions, but we'll also, if any of our attendees either would like to unmute themselves or post a question in the chat, we can talk about those. As you were putting up your brick wall, I just kept thinking of the Pink Floyd song, and I'm thinking that you might want to, put some sort of presentation together with music, and every time they make a contribution to an IRA, it's another, brick in the wall and just makes it harder, something like that. I don't know, kind of off the cuff. Also, with the comment that you're not, assuming any 10-year stretch, which obviously we're going to cover some of that next week. I just had the thought that the average inheritance is spent within 5 years, so people aren't stretching it anyways. So that, I'm sure it could be an objection, but I don't think it's actually a legitimate question. When you present this to, clients, and a lot of clients, I'm going to say, have a hesitation towards life insurance or all the numbers, does the graph sink in? Does it work?
The graph does sink in. So many people understand that. If they haven't done Roth conversions, they've at least talked about the conversions with their clients and their advisors, excuse me. So it seems to sink in. I will tell you that on May 19th, I'm part of another brew where I'm showing the other part of this, which is actually called the cylinders of money. We actually build cylinders on what you could invest in when you come over that tax wall. I'm highlighting today Roths and life insurance, but obviously there's other things that you can do as well. So maybe it's another plug for, joining the brew on the 19th of May as well to see the other part of it. But Brendan, my short answer is this is the beginning part of the conversation, and then there's something else that gets added on to help drive clients towards, a solution that can oftentimes make sense for them.
Well, I'll work on figuring out what that song is, Bill, and I'll tie music to that as well.
I look forward to it.
Anybody else have a question? Now is your chance. Otherwise, we will do our drawing. Bill, would you like to pick a number between 1 and 26, please?
19.
19. Our winner is Holland Slick. So thanks for attending, Holland, and everybody else. You'll be getting both a gift card and a CE voucher. So enjoy them. Maybe you can use them both at the same time. So with that, thank you everybody for attending. We will see you next week on The Brew.